coming up on a jam-packed Money Life.
Investors have been slow to climb back aboard this rally. And so there is a certain amount of FOMO at this point where institutions are realizing that it's been wrong to put too much emphasis on, the end game for tariff resolution. And then, you have to keep up with your benchmarks. And so they're slowly but surely starting to climb on board the rallies. When that gets to extremes, which I think is probably next month, the month of August, at that point, we'll have to worry a little bit more. But for now, I think the market's still in great shape.
Mark Newton, Global Head of Technical Strategy at Fundstrat Global Advisors, talks about how he sees the market rallying through the end of the year, getting through some troubles along the way. He's talking technicals, and then economist Howard Yaris from New York University, author of Understandable Economics, gives his take on the big picture and what's happening now, and makes a point that what's happening now when it comes to economic numbers is that the stuff that was happening earlier this year is about to show up. Plus, Hank Smith, head of investment strategy at the Haverford Trust Company, is here talking dividend growth stocks in the market call.
I love getting up in the morning. I clap my hands and say, this is going to be a great day.
Well, you can all say that this is going to be a great day to live the money life. And that's what you're doing here. This is Money Life for July the 15th. Thank you so much for joining me. My name is Chuck Jaffe, and I'll be your host for the next hour as we have a great lineup for you. I could have pulled a ton of different quotes from both the Mark Newton interview and the Howard Yaris interview. Tons of stuff to get through. Lots of crossover when we're talking dividend paying stocks with Hank Smith. When we get to the end of the show, I'll have a ton of things where it's who did he talk about that other guests have discussed. So you're going to get a lot here, and I'm glad that we can give it to you. Yesterday I was saying, the market's going to open down and we'll see how hard it goes off early and then what happens. And of course, the market did open up down, but not very down, and it didn't hold it for long. And so you have this market that is seemingly showing that it can climb just about anything, but there is plenty of worry. So Wall Street trying hard to keep climbing that wall of worry. And I'm along for the ride. I am. I really am. Even though I won't deny nerves, I won't. Maybe that's because, as I've said before, as a guy who's a couple years away from retirement, I want the market to, if the market's going to have to tank at some point, I'd rather have it tank today than down the line. I would much rather be in a situation where the market gets through whatever it needs to get through and goes. And you will hear Mark Newton give a little bit of that, right? Because he's expecting this to be a good year. For the remainder of this year, he says the market will go up, though it won't be a straight line. With that, he talks about how, well, that would be 3 big years in a row. And if you have 3 big years in a row, you will be at some point positioned where valuations are out of whack and the rest, and you have to have issues. And I mean, I'll go back. Vincent Randazzo the other day talking about this could be like 1998, but without the bubble, right? Well, 1998, if you go back and you were investing during the internet bubble days as the thing was building, man, in the run-up to the bubble, everything was amazing. Investors were super happy, and why wouldn't they be? So that question of, can you have the run-up without inflating the bubble, that's one to keep in mind. If there's something on your mind, don't be shy about sharing it. Chuck@moneylifeshow.com is how you reach me. But right now, we've got to get started because we're going to let these guests run and have some fun. I've told you what's coming. We're talking technicals with Mark Newton to kick things off when the talk really starts, right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals on Money Life, where we demonstrate that getting the expert opinions on what's been happening with the market and what might happen next is going to help you get the peace of mind to understand what we're living through. And returning to Talking Technicals today, Mark Newton. He is the global head of technical strategy at Fundstrat Global Advisors. Fundstrat.com or fsinsight.com if you are looking for more information on the firm or on Mark. Mark Newton, it's great to have you back on Money Life.
Thanks, Chuck. It's great to be back.
We are living through proverbial interesting times. The market has been flirting with record highs again, but there's tons and tons of headline risk. But headline risk is not really technical till it shows up in the charts. As you look at where we are, do we have one of those situations where record highs are going to become resistance and we're going to bounce off it and more likely to head down? Or, the one thing that record highs tend to lead to is new record highs.
Yeah, that's a great point, Chuck. Look, the S&P and Nasdaq 100 certainly at new all-time highs, whereas the eco-weighted S&P, the Dow Jones Transports, the Russell are not. And so right now there's a little bit of divergence where the tech-led, indices have taken the lead and are doing just fine, whereas the broader market still has a little bit of work to do. That being said, I am optimistic for the balance of this year, although I don't think it's going to be a straight shot. I do suspect it will see a little choppiness potentially as early as this week. We've already started to see a little bit of that. With CPI, today being Monday ahead of the CPI, we have started to see evidence of rates creeping higher. That does have the potential of maybe spooking the market, but the one thing I always talk to investors about is look, the market's broadening out. That's a very good sign. And also you have a wall of worry where, investors have been slow to climb back aboard this rally. And so there is a certain amount of FOMO at this point where institutions are realizing that it's been wrong to put too much emphasis on, the end game for tariff resolution. And then, you have to keep up with your benchmarks. And so they're slowly but surely starting to climb on board the rallies. When that gets to extremes, which I think is probably next month, the month of August, at that point we'll have to worry a little bit more. But for now, I think the market's still in great shape.
While we're talking technicals, you look at everything. So we haven't seen the tariff-related CPI increases that we expected. We may still, or maybe we somehow avoid it, or maybe it's a one-time thing. And every time we get more clarity on tariffs, that will push it back to July, et cetera, smaller market downturn. Now we're pushing it back to August, smaller market reaction. So can we normalize this without having the bad stuff we thought was going to come?
Look, the fact that when they were announced, the market did show a hiccup, but largely, we did not see any real evidence of that. So now if they're taken off, I would also suspect that it shouldn't be a big deal. I think investors are giving this way too much weight. When you consider things like AI, which is slowly but surely beginning to help all of our lives for the better, that's certainly a very deflationary force, as is the fact that crude oil, going to be heading lower largely with a lot of supply coming up. Crude certainly getting down towards the low 50s again is also going to be deflationary. So there are some offsetting factors. It's not like, well, tariffs are inflationary, therefore everything's bad. None of that has happened. Powell certainly does seem to think that that's going to be approaching. We shall wait and see. There's nothing technically to be able to comment on that. Even fundamentally, most economists have gotten this dead wrong. So I think that, it's going to be proper to wait. And it's never, ever proper to fight trends and think that politics or, geopolitical escalation or the Fed or anything is important for you as an investor. You really want to concentrate on trends. Trends are very positive right now. Earnings have come in better than expected. Last quarter, they're up 79%, beat expectations. And the economy, to its credit, has been pretty resilient. It's been tough to find real cracks in the labor market, even though hiring has slowed. You don't see massive unemployment. And so those are things that we all have to say, okay, well, the market's sort of in a Goldilocks state because the Fed is certainly going to cut 3 times between now and next summer. Earnings are coming in good, and yet there's still a wall of worry. And so the combination of that still presents a very favorable path, I think, for investing in the second half of this year.
You talked about the Fed. You believe they will be cutting 3 times between now and next summer. That's a slower time frame than some believe.
Right. Well, that's what's built into the Fed fund futures and the swaps. I always put, I'm not an economist, so I basically lean on that. The Fed usually does not like to upset the market. So where the market's priced in the cuts is generally what I talk to investors about. I think that's probably what's going to happen.
Well, I want to pick your brain on technicals with something that might happen, could happen, et cetera, which is we have seen the president, among others, but chiefly the president, trying to put pressure on Jerome Powell to cut rates. He's doing it saying, well, if we cut rates, we're going to see the market take off from here. But this market's taken off pretty well. So if we see a cut sooner rather than later, not Powell necessarily giving into the pressure, just, them saying, okay, this time is good enough. When we had cuts last year, they didn't give us the traditional what you expect out of a rate cut. How do you factor that in? Like, what are you expecting? And if we had pressure to have a cut, would we get the technical reaction that the president seems to hope we would get?
Well, a couple points on that front. Look, initially, it's very difficult to say that one rate cut or cutting now one time, ahead of schedule is going to help the economy that dramatically. I mean, it takes time for these cuts to really bake into what the economic data does. The second is that, the administration's pressure on the Fed actually serves as a source of monetary stimulus because, the market starts to bake in more cuts, knowing that the entire administration is putting so much pressure on the Fed that we know there's going to be a dovish Fed governor that's going to replace Powell eventually, whether it be sooner or later. Whether Powell's resigns, and we've heard rumors of that, it's always tough to comment until something takes effect. But we know now that they're starting to give Powell pressure on a number of different fronts, even outside of his duty. And so I think that, whoever eventually takes over likely will be more dovish. We'll start to cut rates probably a little more quickly. As to how the economy, it's always been tricky to say, well, the Fed's going to cut, therefore it's bullish. But, I do view it as a positive to have rates lower, not higher. I don't sense that inflation is going to come back as dramatically as I think many people suspect. It might come up to show a bounce between now and next spring, but the real worry for me is interest rates rising too rapidly. And if the 10-year were to get up above, say, 480, that would be a real issue. I mean, there's always been worry about fiscal uncertainty, both sides being unwilling to cut spending. Now we have a ton of supply coming down the pipe. Right now, it's been absorbed pretty well, but European sovereign yields have started to back up dramatically, and U.S. yields are following suit. And so that's the key, is that the administration and actually Scott Bessent, they need rates to go lower. We have $37 trillion in debt. About 9 of that's going to come due to be refinanced. And so the sooner that rates go lower, honestly, the better for the entire situation. And I do sense that rates won't stay up forever. We'll start to roll back over. That probably happens sometime in the next month, that we start to turn back lower in yields. But tricky. I don't like to be real political on attacking one side or the other. I do believe that obviously the Fed should be have independent judgment, as most of us do, and there shouldn't be undue pressure. Nixon found that out the wrong way, and many others that have tried to put pressure just to get them to do what they want. I mean, you need to let the market operate on supply and demand. There's a reason why we're in a different shape than Europe. We're a lot more resilient. So why the need to cut rates dramatically if we're not in the same situation as they are?
Yeah, I agree. I'd like to see Powell be Powell, the Fed do its thing, and we may or may not be happy. We may think it might move the market, but let it all happen and then react. But speaking of reaction, as you pointed out, you're pretty constructive on the market for the rest of this year, but you don't think it'll be a straight line. Are there levels how good can we expect this? We're coming off of a couple of spectacular years. And although we did have a correction in the middle of this, how good can we expect this to end up, given that, the first half, maybe we got 6 months that people were expecting when they were looking at the year entering, but it wasn't the 6-month journey they expected. It's just beginning point and end point. Yeah, okay. But the journey itself has been this rough. How much can you expect us to get this year?
When questions like yours cease to be asked, that's when I'll have real worry, honestly. Everybody wonders, is too good? Is too much already been baked in? I do agree. We're sort of late in the cycle. 20% plus years. If this year ends like I think, my target's about 66.50. We're up right now about 6.5. If we go up another 9, let's say we end up 16%. That's a phenomenal 3-year period. I would expect that maybe next year we could show some consolidation if we end up near the highs for this year. You need to see evidence of trend damage and momentum starting to deteriorate, fewer stocks hitting new highs. Right now we're seeing the opposite, and we still have a worry, a sentiment picture that is pretty subdued, to say the least. So For me to get real worried, I want to see those things start to change. I want to see more defensive trading, fewer stocks hitting new highs, breadth really starting to thin out, and sentiment getting really optimistic. And, I think that probably could start to happen next month. I think seasonally speaking, this year has acted exactly as thought it would over the last 100 years, just based on seasonality trends in a post-election year period of when you see an administration change, the first quarter is almost always choppy, if not down. That happened. Then you rally into June, and we see some settling. That also happened. Then you see a big rally normally that carries into August, and then you see August and September are the volatile months of the year. I also think that could happen this year before a fourth quarter rally. So it's proper to pay attention to sentiment, seasonality. Obviously, keep your focus on technology. It's still the biggest sector. It's roared back with a vengeance, and now it's leading in almost every category in terms of 1 month, 3 month, year-to-date performance. That starts to change a little bit, then I'd be, have a little bit of worry. But, investors need to utilize technical analysis. You need to keep an eye on trends, but also earnings in the economy, and really, put the blindfolds on and try not to listen to what's happening in the news and the exogenous events as much as we all have an interest in that area. But you need to separate that from your investments, because rarely do you see that materialize or happen as quickly. Even the economists talking about inflation spiking, it just hasn't happened. I really like to just be focused on what's moving now, and really not my fears about what could derail the market and the economy.
Well, you've helped allay some of our fears, or the fears I hear from my audience. Meanwhile, this has been great. Mark, always great to catch up with you. Love the perspective. Look forward to doing this with you again down the line.
Thanks, Chuck. Have a great summer. And you and all your listeners, take care, everybody.
That's Mark Newton. He is Global Head of Technical Strategy at Fundstrat Global Advisors. Go to fundstrat.com or fsinsight.com, actually, and fsinsight.com. And speaking of insight, well, if you're looking for more, we've got more to go on this show. Up next, Howard Yaris, economist, will be here, and he'll give his take on the economy in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome to the big interview on the July 15th edition of Money Life. Returning to the show today, Howard Yaris, professor at New York University, an economist and the author of Understandable Economics, because understanding our economy is easier than you think and more important than you know. That book there's a fully updated version of it that is coming out next month. So Howard will probably be back and we'll discuss Understandable Economics again. Meanwhile, if you want to learn about the book or you want to learn about Howard, howardyaris.com. Howard Yaris, it's great to have you back on Money Life.
Great to be back, Chuck. Thanks so much.
These are certainly those proverbial interesting economic times. You are the guy who wrote Understandable Economics. Help us understand why the things that we think we know, like, hey, you have tariffs, you're going to see higher inflation, you're going to have problems. Why we're not really seeing all the things. Like, we're super nervous about what the economy is doing, and yet the numbers are all still good and they still seem to be looking good. So why do we have a disconnect between what we think we know and what the numbers are telling us we know?
I always love one-word answers, and I can give a one-word answer and then I'll explain it. And the one word is lags. There is a lag between economic policy, for instance, the most obvious being when the Fed lowers interest rates. It takes a long time for that to ripple through the economy. They often lower interest rates to get more economic activity going, and that takes months. The same thing is true with tariffs. What happened when Trump first announced his tariffs? U.S. businesses imported a lot more goods to the United States than they normally did in anticipation of the tariffs going up. So basically, the inventories are stuffed with stuff now. And so you haven't seen the upward pressure on prices yet, simply because the importers have a lot of inventory. As that inventory gets sold off, that's when you'll see the upward pressure on prices. So that's one reason. Another reason is that a lot of people focus on tariffs. And let's take a step back. For some of the people in your audience, I know you have a very sophisticated audience, but what is a tariff? It's very simply a tax on imported goods. So everyone talks about how it's going to ultimately, after the lag, make imported goods more expensive. But what happens when imported goods get more expensive? What happens to the price of domestic goods? Any domestic producer who watches their competitor's price shoot up is going to have more leeway to increase their own price. So it's going to not only affect the price of imported goods, but ultimately, again, after the lag, affect all goods. So inflation is likely coming, especially if the administration doesn't pull back on the tariffs. And it's a question of time and not if.
When you consider what we've also seen, economically speaking, the rate cuts we saw last year didn't have the impact that we would normally expect out of rate cuts. And we've got a president who's pushing for the Fed to cut rates right now, and we've got a Fed that's considering it. Are these normal enough economic times that if we get a rate cut, we should expect it to feel like rate cuts normally feel?
My guess is that the Fed is waiting to see the effect of the tariffs. I think that they expect tariffs to increase prices, and therefore they'll have a justification for not lowering rates. They're looking for a justification to not lower rates. And if inflation doesn't happen in the next few months, I think the pressure on them to lower rates is going to be so big that they'll ultimately lower them. But I think what they're trying to do is wait long enough so the lags pass and we start seeing the increase in prices, and then they have a rock solid justification for not lowering interest rates. But again, I think they're just trying to wait this out to see what happens.
If they wait too long, is there an economic impact? Or once you cut them and rates have moved and the economy reacts?
Here's where everyone thinks macroeconomics is a science like physics or biology. It's more like psychology, and I'll explain why. If prices start going up due to the tariffs, foreign imports go up due to the direct tax on them, and then the domestic producers increase their prices, you can have a slowdown in the economy. People spend less. So, on one hand, prices are going up. And on the other hand, you could possibly have the beginning of a recession. What is a recession? People cut down on spending, incomes drop, production drops, everything starts dropping. So they're between a rock and a hard place at that point. They're seeing increasing prices on the one hand, which normally causes them to lower interest rates. And you're seeing increasing prices, which normally causes them to raise interest rates. And you're seeing lower economic activity, which causes them to lower interest rates. So they're literally between a rock and a hard place. And how that plays out, I don't think you're going to find a guest who can give you a definitive answer as to how that would play out. But that's what's called stagflation, and that's a mess. And it's not clear what the Fed is supposed to do in that situation.
I would agree. And as we said, we take a lot of predictions and we take a lot of projections, but we don't necessarily take any of them seriously until we actually see them in the numbers, which brings me to this idea of we have seen consumers who have continued to spend. That's part of that equation you were talking about a moment ago, in spite of the fact that when you ask them emotionally how they're feeling, they're pretty messed up by everything that they've seen. And, they're scared about what's happening with tariffs. And they say that they're adjusting behaviors, though we don't seem to see it. Given that you talked about lag and lag being important, are you worried right now that we will see also a lag in the consumers saying, I'm scared, showing up? In other words, that they actually are going to change their behaviors and it won't be this disagreement between hard and soft data. They will agree.
We've already seen the beginning of it. The last consumer spending number showed a very small, a 0.5% reduction in consumer spending, which sounds very small and it is not particularly large. But given that almost 70% of our economy is due to consumer spending, that's an impact. So the question is what's going to happen? And I think it's really just arithmetic. It's not subjective that prices are going to go up if the administration persists with the tariffs. That's just a tax. It's a number, and it's going to have to be collected, and prices are going to go up as a result. How consumers react is much more subjective, but I think given that consumer sentiment and a lot of uncertainty in the economy, there is a significant chance that consumers pull back. And there are a lot of headwinds to consumer spending. the number of layoffs, government layoffs, the level of uncertainty given economic policy, the high interest rates. So there are a lot of headwinds for consumer spending. So again, we're back to the situation, and no one could say definitively this is what's going to happen. But you have higher prices and less consumer spending, which implies a bad economy or a recession, is arguably the worst situation to be in for an economy.
At the same time, the vast majority of economists who I've been talking to went from radically raising their fears of recession in April to virtually eliminating their fears of recession by June as the market was getting back to record highs. And the economy and the market do not have to move in lockstep by any stretch of the imagination. But I find it much harder right now to find people who think recession is coming at any point this year for sure. So, do you think that the other guys are wrong? Like, you sound like recession is certainly in your playbook at this point, in your planning process, but how quick?
Here are a few facts. One, the wealth effect. The stock market, we were discussing a moment ago. Some people call it a melt up. People feel wealthier. When people feel wealthier, they spend more. Also, Chairman Powell's term is up in May of next year. And the likelihood is that Donald Trump will put in someone who's going to put downward pressure on interest rates, which juices the economy. So the thought that we're going imminently into a dire recession is a bit far-fetched. So there's just like there are a lot of headwinds to consumer spending, there are some other things that are protective of the economy. So to say yes, we're moving into a recession definitively sounds a bit overly pessimistic. On the other hand, we're entering, this is the main point I want to make, literally uncharted territory. We have never had tariffs like this. The Smoot-Hawley tariffs from the Depression, it was 100 years ago. It was a very different economy. The whole world economy expects relatively free international trade, and that's being upended now. And the effect of that is it's very hard to say how that will play out. As we started this conversation, we're living in a time of great uncertainty. And I don't think anyone could say definitively what's going to happen, but there are certain red lights for me. One is the increase in prices due to the tariffs, a tax on imports, and a green light to domestic manufacturers to raise their price as their foreign competitors, the price of the foreign competitors goes up. And the uncertainty created by all of this, which has to have some effect on the psyche of consumers.
Comparing domestic economics and international economics, I mean, there's other countries on the other ends of the tariffs. They are facing other pressures. Their central bankers have been cutting rates much more aggressively than anything we've even heard of the Fed thinking about. Are you at a spot where you think, we're sizing up what areas of the world are going to win and lose out of this international trade realignment?
Oh, let me be clear. If it weren't for the tariffs, I would bet a lot of money the Fed would have lowered rates by now. A lot. I think it's the fear of tariffs and what that can do to prices. Again, the Fed has a dual mandate. And one of the two things that they're responsible for ensuring are stable prices. And I think they're very concerned about that. That concern would essentially go away if we didn't have this tariff war going on. So I think the United States, the Fed, the United States Central Bank would be doing what most other central banks are doing, lowering rates, if it weren't for that one issue.
Do you look at this economy, because we're not lowering rates, but because we're also the driving factor on tariffs with everybody else, as we're the power players, or they have the healthier economy with the lower rates and they may have the growth that we're potentially going to lose in that lag situation, and that therefore they have more strength?
I think the chaos is the biggest factor here. Donald Trump talks about Europe and how they are difficult with trade. Our average tariff for European goods coming to America is about 1%. There's really not room for them to negotiate. Most trade is almost free. So it's not clear what these countries are supposed to do. And I think that's causing a lot of consternation on the part of these foreign governments. And more importantly, in the long run, it's causing them to maybe not have as strong a relationship with the United States, and no one knows for sure when the strength of that relationship is going to be important. But inevitably, there will come a time when the United States is going to need its allies. And I hope the bonds are as secure then as they have been after World War II.
Yeah, because what we export more than anything is our debt. So
we export a lot of debt, and that's another thing. The interest on our debt is shortly going to exceed virtually any other expenditure of the federal government. The interest on the debt is soon going to exceed $1 trillion a year. And the United States must be able to sell that debt to fund its deficits. And if it can't sell those debts, the interest rate is sure to skyrocket. And that's going to be quite a drag on the economy.
when you consider, free trade and tariffs and where they have been, et cetera, there are folks who are saying that the tariff resolution, whatever it winds up being as we get the final stuff done, is basically an end to free trade. And that maybe it's a necessary end to free trade because we need to have the tariffs to fund other things or what have you. But if these policies don't work, is there a way to walk them back, or damages are done? Here you were talking about, we don't know how the rest of the world's going to see things. What is a likely resolution on the good side and also on the bad side?
Well, let's think that through. To the extent that tariffs hurt free trade, that means we're not collecting much money in tariffs, because if we're importing less stuff, there's less stuff to tax. So you can't have it both ways. You can't say, well, it's ending imports, and yet we're collecting a lot of money in tariffs. It's one or the other. We only collect money on tariffs if we have a lot of imports. And if we don't have a lot of imports, we don't collect money on tariffs. So that's a false dichotomy with regard to tariffs. Can we walk it back? Sure. Just as the administration has increased taxes on imports through tariffs, theoretically, they could bring them down as well. I will note, as a lawyer, it's not clear that the president has the authority to unilaterally impose tariffs. The Constitution clearly provides that the Congress has the right to impose those taxes. And right now, there is a case in the federal courts, and the lower court said that's in fact right. Only Congress has the ability to impose these tariffs, not the president. How that plays out at the Court of Appeals, and what I'm sure will be an appeal to the U.S. Supreme Court, we'll see. But in my opinion, I think these tariffs are not legal. So in any event, the lower court did say while the court case is pending, the tariffs will remain in place. So the tariffs will be there. We have two things. One, what the court ultimately says, the Supreme Court ultimately says, are they legal or not? I think legally, the better argument is they should all be thrown out. It's Congress that has the ability to impose these taxes. And if they don't throw them out, the administration itself, the last time Trump announced massive tariffs, stock market tanked, as you recall, and he walked it back, the taco trade that Trump always chickens out trade. Will he do it this time? I don't know. He's not as predictable, which, going full circle, is in and of itself a drag on the economy.
Well, talk about a lag. If we've got to rely on courts to make some of these decisions, the economy will have decided for us as we're waiting. Howard, great stuff. Thank you so much for joining me to talk about it. We will talk again when the next edition of the book is out.
Thanks a lot, Chuck.
That's Howard Yaris. He's professor at New York University, the author of Understandable Economics, because understanding our economy is easier than you think and more important than you know. There will be a new version of that out next month. And if you want to get more information on him or the book and more, go to howardyaris.com. But other than checking out the website, don't you go anywhere, because we're going to take a quick break and then it's market call time. Hank Smith, the head of investment strategy at the Haverford Trust, will be here talking stocks when Money Life comes back right after this message. Hank Smith, head of investment strategy for the Haverford Trust Company, is here. We're talking stocks. It's market call time. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Returning to the market call today, somebody that I know you guys like because you like what he puts into his stock picks, where he's looking for really good balance sheets and growing dividends, etc. He's also, by the way, the host of the Quality Wealth Management Insights podcast. Hank Smith is the head of investment strategy at the Haverford Trust Company, based in Radnor, Pennsylvania, managing about $15 billion in assets. You can go to haverfordquality.com to learn about him and the firm. And again, the Quality Wealth Management Insights podcast, on which, by the way, I have been a guest. Right now, he's our guest here. Hank Smith, welcome back to Money Life.
Chuck, it's great to be with you again. Happy summer.
It's off to a good start, and the weather's certainly getting good. The stock market weather, well, there's always storm clouds out there. But before we get to any of those, I did a very cursory job of saying that you like the great balance sheets and the dividends. There's a lot more that goes into it. So let's talk about your methodology. You have a universe of companies that you're willing to look at. It is not the entire universe. So explain what it is that you are looking at and then how you decide from there which ones are your buys and sells.
Absolutely, Chuck. And, we've been doing this consistently, implementing this investment philosophy since 1979, and we have not wavered from it. And what we're looking for is large, established companies that have very strong balance sheets, that pay a dividend. That's a requirement, but we place more emphasis on growing dividends based on earnings growth. That is something that's very underestimated by investors, is the power of dividend growth. And I'll give you a little bit later on some examples of that. So when you look at large cap, established companies, high quality A-rated balance sheets, dividend payments, growth of dividends, it's really a universe of about 250 companies that fall into that. And then we're investing, we have three active strategies: a quality growth strategy, a growth and income strategy, and a dividend yield strategy that all come from the same universe. And we're managing diversified portfolios in order to control risk, but we're not over diversified. These are portfolios of 30 to 40 names, not 100 to 200 names. So they're relatively concentrated positions when you're talking about a 30 stock portfolio.
That emphasis on growing dividends, we are at a spot where valuations have been getting a little frothy as we get the market back towards record highs. How does the dividend picture look to you right now? Because dividend yield's not high when markets get too high.
That's absolutely correct. And yet, look, I think you have to separate the broad market in which you can find attractive valuations versus, let's say, the market cap weighted S&P that is so skewed to the top 10 stocks, the largest 10, 15 stocks. But if you look at the equal weighted S&P 500, I think you'll find the valuations look more attractive, and you can find some dividend yields or higher dividend yields in this environment. But certainly it becomes more difficult as the market marches to all-time highs.
When you are looking at developing your portfolios, do you worry about being overweighted in one or two areas? Because, of course, faster growing places typically have lower dividends. So as you're getting there, how much do you worry about making sure your portfolio is fully diversified? Do you have a limit on how many performers you'll buy in any given space?
We do. We're not trying to be a closet index fund. We do look at the weightings of the sectors compared to the S&P 500, but we limit our exposure to sectors that are under 10% of the S&P 500. We can have 2 times greater exposure. When you're looking at sectors that are over 15% of the S&P 500, it's 1.5 times. So we do pay attention to that again in terms of managing risk. But there's certain sectors we have zero exposure to, mostly because they don't meet the quality requirements. For example, REITs, which are generally leveraged, so they don't have that A-rated balance sheet.
So what are the areas that stand out to you right now?
So our 3 largest exposures in terms of sector exposures is technology, industrials, and financials. And there are 2 secular themes that we believe we're in, since it's summertime, Chuck. It's baseball season. I know you're a lacrosse player, but it's baseball season that we're in the early innings of. And one is obviously AI, artificial intelligence, but then two, the electrification of the economy. And this goes way beyond just, electric vehicles, but it's the data center build out to support AI. It's industrial buildings and in industrial plants, power plants, because we need a lot more power to drive AI. And so we're in the very early innings of what we think is a long-term secular trend. And then with respect to financials, the big tailwind there is deregulation. We have had in the previous administrations 4 years of the most suffocating regulation. Part of the excitement in the market when this new administration took over earlier in January was deregulation. And you're seeing it in the financial system and you're seeing it in energy, but I think you're going to see it everywhere eventually. And that is a very underestimated driver for GDP growth because regulations are a cost. They're no different than taxes in that respect. And the more regulation you have, the higher your costs. And guess what? We, the consumer, pay in terms of higher prices. So we think this is a very powerful tailwind, and the financial sector looks very attractive to us.
Now we know the sectors you like. Got a name or two that really work for you in those sectors?
Sure. And again, we're trying to focus on the highest quality, the best managed companies. And let's just start with the financials. The highest quality bank, the best run bank in the world, not just in the United States, is JP Morgan. It's been a long-term holding of ours. It's a very big position in our portfolios. And then in the asset management side, BlackRock is the best managed company that continues to perform very well. And they're getting into other areas like private equity, in addition to their huge footprint in indexing and exchange traded funds. Those are our two biggest financial holdings. Taking it to some of the other areas, in industrials, I would focus on Eaton Corporation, symbol ETN as in Nancy. That company is at the forefront of electrification and data center build outs. And again, while the stock has done very well and has an elevated PE, we're in the early innings of this, so they have a continually expanded backlog of orders, and I think they have a runway for tremendous growth.
What makes you sell once you find these businesses? And you and I have talked plenty of times, but you're always more positive and looking more at the buys than the sells. So what is it that makes you give up on something?
In that perspective, we're trying to identify companies that the odds favor us being a long-term shareholder because of the quality and the consistency and predictability of earnings growth. But occasionally a blue chip will turn into a cow chip. We want to try and avoid those, or that there'll be problems in the growth story that are more than just cyclical, short-term in nature, but have more intermediate, longer-term headwinds. So two companies that we sold over the past year, but a little over a year ago in the consumer space, Nike and Starbucks, they both have China problems. One, Nike manufactures a lot of shoes in China, and two, the Chinese are not buying Nike products as much. And Starbucks, they're pushing away from consumption at Starbucks. And then they both face a ton of competition. And Nike really, from an innovation standpoint, kind of dropped the ball a little bit and allowed brands like Hoka and On, I believe is the name of it, to really capture a lot of market share that Nike previously owned. And Starbucks, well, there's a Starbucks type coffee shop at every single corner of every block in every city. So we think those are more longer term problems. And then more recently, we sold a long time holding, United Healthcare, because we believe the regulatory problems and the problems that they're facing in terms of the Justice Department scrutiny are going to hang over them for several years. And so we took our profits there and moved on.
Well, now we're going to get your quick and dirty take on some stocks that my audience is particularly interested in.
Quick and dirty.
Here comes the good part.
Well, I don't know. It's been a lot of good parts already, but I know some of you think that the best part is our lightning round. That's what we call quick and dirty. And we're doing it today with Hank Smith, the head of investment strategy at the Haverford Trust Company, which runs $15 billion in assets. You can learn more about the firm at haverfordquality.com. And again, Hank is also the host of the Quality Wealth Management Insights podcast. You know how to get into Quick and Dirty. Send us your name, your hometown, and the ticker symbols you're interested in to chuck@moneylifeshow.com. We're going to start today with a request we got from Sam in Waterfleet, New York, and Dave in Jacksonville, Florida. They both wanted to know about Philip Morris International. It's ticker PM.
It's our largest consumer staple holding. Look, we all know that cigarette smoking is in a secular decline, but Philip Morris is shifting away from combustion with two products, IQOS, which is heated tobacco, and ZYNs, which are nicotine pouches. And I'm going to say something a little controversial here, but it is the truth. Nicotine does not cause cancer. Combustion, smoking, and the chemicals in tobacco is what causes cancer. So I think they have a tremendous runway with these nicotine pouches as that really takes over the market. I know nicotine's addictive, but you know something, Chuck? Coffee's addictive too. It does not cause cancer.
Smoking.
Yeah, smoking. The stock at least is smoking. The customers may or may not be, but that's a buy on Philip Morris International, ticker PM. Dave in Jacksonville has our next request to himself. It's MasterCard, ticker MA.
You know, the beauty of our economy is it's now being driven almost 3/4 by consumer spending and services. And at least in the United States, the U.S. consumer has a gene that's called spending. And regardless of what consumer sentiment or confidence is, we still spend money. And MasterCard's a beneficiary of that. They're also a beneficiary of the increasing wealth in emerging economies around the world. And so this has been one of the steadiest performers in terms of earnings growth and dividend growth. And we don't see this really slowing down anytime soon. So we think it's a great buy right now.
Unlimited credit. That's what it means. An open charge account with no reckoning.
Well, the reckoning has been that MasterCard, ticker MA, has a lot of room to roam because of the credit that people are using. That's a buy on MA. Laura in San Antonio, Texas, wants to know about Johnson Controls International. Ticker symbol is the initials, JCI.
Just like Eaton, Johnson Controls is positioned incredibly well for this data center build out that has to occur to support artificial intelligence. And this is a company that has been very well managed in the last few years, making this transition to focusing on electrification, you know, the same theme that I talked about earlier with Eaton. I think Johnson Controls and Eaton are really the two names to own in industrials.
Buy it outright.
Yep, that's a buy on JCI, Johnson Controls International. Richard in Chula Vista, California wants to know about Cisco Systems at CSCO.
Well, we own Cisco Systems in our yield strategy, but it's been doing pretty well over the past year or so. So it doesn't quite have as juicy a yield, but it's still 2.6%. And a valuation that is well below the markets and well below the tech sector, if you will. And Cisco is becoming a quiet play on AI. They're supporting some of the things NVIDIA is doing. And I don't think they're getting too much credit. It's also a play in security, which is increasingly becoming a more important for the business community. And it's again, it's not a challenging valuation. Does it have the super fast growth rate of some of the other big tech companies? No, but we still think it's a steady Eddie and can reward shareholders with continued dividend growth and a decent size yield compared to the market.
If you buy right there, and then you sell there, you see what I'm saying?
Yeah, what Hank is saying is that this stock still has room to go. So you're not going to be selling it. You're going to be buying it here. CSCO was a buy. And last, for Ted in Cincinnati, but also for me because it's in my portfolio and one of my largest holdings, it's Microsoft MSFT.
Well, Chuck, they used to call it Mr. Softy because of the symbol MSFT, but I don't hear that too often anymore. But you and I have been around long enough that we do remember traders using that. It's hard not to own this stock. It is really, you talk about a company that has a moat around it, that is a leader in cloud computing, a leader in AI and the implementation application of AI, incredibly well managed. It really should be a core position in anyone's diversified portfolio.
So we finish on a high note. That's a buy on Microsoft MSFT.
Bye. Is that all you can think about?
And yeah, all we've been able to think about during Quick and Dirty is good buys because we've had 5 buys in a row. We got one more good buy to talk about. It's the one where I have to say our goodbyes to Hank Smith. But Hank, always a pleasure to have you on the show. Thanks so much for joining me.
It's great to be with you and your broad and large audience. Thank you, Chuck.
Hank Smith is the head of investment strategy for the Haverford Trust Company. HaverfordQuality.com if you want to learn about the firm and what they do. And if you want to learn where Hank agreed or disagreed with some recent guests, stick around because we'll get that before we wrap things up after this message.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
We're back to wrap things up. A lot to do in a little bit of time, so let's jump straight in. And before we get to crossover with Hank Smith, 2 things. One, Howard Yaroff discussing whether the tariffs are legal and the court cases. Well, I wasn't getting into it with him. I know I'm going to get some emails from some of you, etc. It's not a disinteresting discussion, but if you're wondering why I either didn't engage and say, yeah, but, or whatever, well, in the meantime, tariffs are happening and the market is reacting and we as investors have to live with it. And we have to deal with it. So I'm much more concerned with that. If somebody winds up saying the tariffs are illegal and it changes things, we'll deal with that. If they say the tariffs can go forward, we'll already be positioned. So you never know where a guest is going to go. I was a little surprised that Howard went there, but it's not my place to correct somebody or tell somebody what I think, et cetera. In those cases, it's I'll let them go where they think things are important to get to. But again, I'll probably hear from both sides on that. On another front that's happening, you heard Hank Smith discuss deregulation and how it impacts banking and financial services. Well, tomorrow you will hear how it impacts everyone and everything with Michael Gayed, who has been on the show many times before, but he has done something new, which is that he started the free markets ETF, which is all about the deregulation play. So you'll learn about that tomorrow. Plus, Natalie Abahoff Jacobson, global investment strategist for the Hartford Funds and more. So plan to be here tomorrow. Crossover with Hank Smith, tons of it. So it started with JP Morgan, which was his first pick. Brian Mulberry from Zacks Investment Management was buying it on April the 10th. Mike Bailey of FBB Capital was buying it a week before that, which was a day after Taylor Christoviak of Themes ETFs was buying it. Ken Mahoney from Mahoney Asset Management was buying it back on January the 23rd. Then you got through to Nike, which was a sell. Jay Woods from Freedom Capital Markets back on March the 5th, was waiting for the turnaround story on Nike. He was not buying. In fact, he said, among other things, that he preferred Starbucks, which is important because the next stock that Hank Smith said was a sell was Starbucks. And Craig Gaventer from Focus Wealth Partners was buying that back on February the 3rd, but you had Jay Wood saying he liked it in that other interview, literally in context with Nike. So you have Jay Woods agreeing and disagreeing, I guess. Then you had UNH, United Healthcare. It was a sell. Mike Bailey was buying it back on April the 3rd. During Quick and Dirty, Philip Morris was a buy today. Craig Gaventer was buying it on February the 3rd. MasterCard was a buy today. Greg Halter from Carnegie Investment Council was buying it on March the 27th. Cisco was a buy today. Taylor Kristkowiak from the Themes ETFs was buying it on April the 2nd. And then you get to Microsoft, so buckle up. Ed Schill, Wealth Enhancement Group, the QCI team, was a hold, but said he had his stops in place on Microsoft back on June the 23rd. Everyone else I'm about to mention was a buy. Brian Mulberry from Zacks Investment Management on April the 10th. Will Ryan from Granite Shares on February 27th. Jerry Sneed from Procyon Partners on February the 12th. Jeff Garbaz from Quantitative Partners on January the 30th. Max Wasserman, Miramar Capital, 2 days before that. And Ken Mahoney from Mahoney Asset Management, 5 days before that on January 23rd. Now that we've gotten through that, we can talk about what you can celebrate. And today is National Give Something Away Day. If you are not a member of a Buy Nothing group, but you're like a Facebook member, go find your local Buy Nothing group. Give things that you don't need away. Take things that other people don't need. It's just good for everybody. It's also National I Love Horses Day, National Pet Fire Safety Day, and I don't know if you call it on the food front exactly, but it's National Gummy Worm Day. I guess they're food. But it's also Orange Chicken Day. I don't know that an orange chicken makes that noise. And National Tapioca Pudding Day. My guests today were Mark Newton, Global Head of Technical Strategy for Fundstrat Global Advisors, fundstrat.com, fsinsight.com. Howard Yaris, howardyaris.com. He's a professor at New York University and the author of Understandable Economics. And Hank Smith, Head of Investment Strategy for the Haverford Trust Company, haverfordquality.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here. Because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Jason Zweig, who said, investors have a more urgent obligation than ever to ensure their own heads are screwed on straight. Yes, we do have that obligation. And if you want to make sure you're screwing your head on straight, all you got to do is remember what I tell you every day, which is until we do this again the next time, the best thing you could do for your money is to not worry too much about it. Have a great day, everybody. Stay safe and stay calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
There's more to life than a little money, you know. Don't you know that?